All right, so let's talk about the Canadian tax system and how it treats passive income and active business income differently, especially when it comes to Canadian-controlled private corporations, which I'll call CCPCs, but they're like the mom and pop kinds of businesses. But first, before I get started, get subscribed and notified. Like and comment if you found this video helpful. And if you're not a client of mine, book a call. I'd like to do something about that. All right, so here's the deal. CCPCs are companies that are incorporated in Canada and they're controlled by Canadian residents. You know, the mom and pop size companies, which are a big piece of the population. Now, when it comes to passive income and active business income, there's a difference in how they get taxed within the CCPCs. Active business income, which is the money a company makes from its regular operations like plumbing or electrical or accounting, tends to get a more favorable tax treatment. You pay the rest of the tax when you pay out the tax paid profits to the shareholders. There's this thing called the small business deduction, which allows CCPCs to pay a lower tax rate on their active business income. And this is basically an incentive to promote and support small businesses and also to encourage them to reinvest in the small businesses. Now, on the other hand, passive income, which includes stuff like interest, income, and capital gains and rentals. Yes, rentals. A lot of people I talk to are surprised by this because, you know, rental properties can be a lot of work. It doesn't matter. The CRA considers the income from long-term rentals to be passive. And these passive type incomes are not eligible for the same sweet small business deduction. It's usually taxed at a higher rate, a much higher rate, like it can slightly exceed 50% in some provinces. The government does this to prevent people from using CCPCs mainly as a way to reduce their personal tax burden by earning passive income through the corporation. Now, there's a weird catch that I'm going to try to explain and then give you a real life example. There's this thing called the refundable dividend tax on hand account, or it could be called NERDO or ERDO. But let's just call this a bank account for your company that is held at the CRA and it doesn't earn you any interest, and the only way you can get a withdrawal from the account is to pay yourself or your fellow shareholders dividends. Now, here's the interesting part. When the corporation distributes the dividends to its shareholders, it's going to be eligible for a dividend refund, which is what is in that account. And this is where things get a bit complex, but stay with me. The dividend refund is designed to partially offset the higher taxes paid on the passive income and allows the corporation to get back some of the taxes. And by some, I mean like just about 50% of those taxes that it previously paid when it distributes the dividends to its shareholders. And the idea behind this system is to make the overall tax burden on passive income closer to the tax burden on active business income. It's just a way to avoid having too much of a gap between the tax rates on different types of income earned within the corporation. Now, let's break it down into simple terms with this everyday example. So imagine your Canadian business is like a pizza shop and you make money in two ways. By selling pizzas, which is your active business income, and also by renting out a room in your shop to a neighbor, and that's the passive income. So for the money you make selling pizzas, the government gives you a special discount called the small business deduction, and it's like a reward for being a small pizza shop, and it helps you pay less tax on that money. But for the money that you make from renting out that room, the government doesn't give you that same discount. They charge you substantially more tax on that rental income. Now, let's talk about how you can get some of that extra tax back. So imagine you have a special savings jar called the refundable dividend tax on hand jar. And every time you pay more tax on your rental income, you put that extra tax into the jar. Later, when you decide to share some pizza profits with your friends, and that's your fellow shareholders, you take some of that money out of the jar to help pay them. It's like using the extra tax that you saved up to make sharing your pizza money a little bit easier. This way, even though renting out the room had a higher tax, you can use the money that you saved in the jar to balance things out when you share the profits with your friends. So, in a nutshell, the government gives you a discount on your pizza money, active business income, but charges a bit more on your room rental money, passive income. And you save a little extra tax in a special jar, and when you share pizza money with friends, you use that jar to make things easier. This helps encourage you to keep making delicious pizzas active income, instead of just renting out rooms, passive income, to get tax breaks. Okay, that's it in a nutshell, and I hope you enjoyed it. And I know that I talked about pizzas a lot, which has made me hungry, so I'm going to run out and get a slice, and I encourage you to as well. Stay hungry, my friends.